And the question is, for all you mid-round VCs listening in, if all of the noise about, okay, startups can need $1 to $3 million and then fund themselves out of customer revenue and still achieve like venture scale outcomes, if that's true, like what happens to the middle part of venture is a really interesting question.
I love this question. Welcome back to the Ignite podcast. Today, we're delighted to have Peter Walker as head of insights from Carta, a man who needs no introduction, but I will allow him to graciously give his own introduction on the Ignite podcast. Welcome to the program.
That is completely untrue, Brian. But yeah, happy to be here. As you mentioned, I'm Peter, and I run the insights team at Carta. And Carta is a cap table management platform. We have about 43,000 startups on the platform right now. So that sort of level of access gives us this wonderful data set on which to build aggregated and anonymized trends about what's going on across the startup ecosystem, in particular here in the US. So happy to be here.
Yeah, and I'd love to just kind of, I usually start take this almost chronologically. I'd like to start with like kind of the genesis of you getting into this space and how you ended up at Carta and interested in venture capital.
Yeah, so I've only really worked at small startups for the vast majority of my career. I started a company in college and then ended up jumping around to small startups in the early part of my days after school. And then during the pandemic, I actually ran the data visualization team for the COVID tracking project, which was actually housed in the Atlantic magazine.
Oh, wow.
So that was
I remember that.
Yeah, it was
really well done.
Thank you. Absolutely wild experience. Like 200 or 300 people in a Slack channel. You'd never met any of them. It's completely, everyone's at home and pretty scared there in April or May 2020. And it was this kind of PhD in putting out data at scale and getting a ton of feedback, good and bad. As you can imagine, my DMs were kind of a mess for that year. But it gave me this idea that, there are a lot of data sets across B2B SaaS where I'd been spending a lot of my time in early startups that have this level of interest. And so I wrote down a few companies that I thought would be fantastic and would have this level of data that I could help bring to the public. And Carta was like obviously top of that list. So got introduced to the CMO here and badgered her for a job for a little while. And so that's how I got in. I was looking for a data set to do this with, and Carta just happened to be the best place to be.
Yeah, I mean, what a privileged company to be at if you're interested in having, first-party primary research data for the venture community. I mean, Carta has more than anybody probably.
Yeah, I feel pretty lucky.
So tell us about why did venture capital go to hell in a handbasket in 2022? Like what happened? What are some of, obviously we had this hangover from 21. We had all-time highs. I mean, I saw it as an investor. We had rounds that are 100x, 200x, 300x, and we still have some of that in AI right now. So yeah, what happened and why did things just go kind of so cold?
I mean, it's a confluence of a lot of things. I think people would point first and foremost to interest rates changing. Cost of money kind of flows to the entire rest of the economy, and startups are no exception there. As risk capital gets a lot more risky, if you can make 5% in a savings account, a lot of funding will go into less risky assets at that point. And startups are basically as risky an asset as you can invest into on an individual basis. So that's number one.
Is there any riskier asset class in startups, I wonder?
I mean, no idea. Like, I guess perhaps international startups, if we were
international startups in developing countries. Yeah.
Right, exactly.
That would probably be the only,
But I'm with you. Like, this is it.
This is it. This is as risky as it gets.
Founders are taking real risks here. So, I mean, respect to those people. The other thing that happened, as you mentioned, like to me, there's never not a bubble in startups. It just happens to be like which bubble you are. You're either on the back or the front end of a bubble. And
it's either expanding into a bubble or bursting.
Or like slowly popping.
Yeah,
right.
Yeah.
So, and we had the crypto bubble and that was everybody's favorite thing for a while. And now we have the AI bubble. And AI, I mean, speaking personally, I think AI is a lot more real than crypto for a lot of different use cases.
Yeah.
But there's no doubt that some of the 100 or 200x multiples that you're seeing as an investor right now, like the possibility of a lot of those companies panning out is still relatively slim. Like, so we're a little bit more realistic across the ecosystem right now, but there's always pockets of craziness.
Yeah. And, what are you kind of seeing now that we're almost a full quarter into, 2024? I've definitely felt it as an investor, as I go out and, make investments and, what my LPs are saying and things like that. But I would love to get some data behind my hunches here as somebody who looks at the data all the time.
All the time. I think we've started 2024 on a slightly more positive note than the majority of 2023. If I had to guess, 2023 is going to be the low point for invested capital into Carta startups for quite a while. Now, if you just look at it on a relative basis, like in Q4 21, something like $65-66 billion went to Carta startups. That's a wild quarter.
Yeah.
Versus 12 or 13 billion in Q4 of 23. So that's an 80% drop.
75-80% decrease
right.
year over year. Wow.
Wild. And so that's that's 21 to 23. Q4 or Q1 24 I think is going to be better. And so I think we're on this slow climb to a more normal state. The difference of right now though is that it's much more than in 2020 or 2021 when it felt like the climb was basically everyone was up and to the right. Right now I think there's going to be, at the same exact moment, you can read through TechCrunch and there'll be a big headline about some gigantic AI round. And then the next thing will be a late stage startup that you're familiar with shutting down. So it's like a very dichotomous, bipolar sort of feeling at the moment.
Yeah, that totally makes sense. And it was interesting as an investor to kind of see, definitely the valuations get compressed, especially from 2021, where, I saw pre-revenue, pre-launch startups with a few engineers, raising at 50 caps.
Wild.
You're like, well, what is going on? And you have no revenue, you have barely a product.
Right.
To getting into companies that have 500K of ARR for a 5 to 10 cap. So these very reasonable pre-seed seed 10 to 20x kind of valuations, at least in B2B SaaS. Is that kind of what you're seeing in the data as well?
Yeah, I think this is actually a place where Carta data is, not to toot our own horn, but maybe even better than the other data sets out there, just because we have access to safes and convertible notes in a way that more priced round focused databases don't have. So across the safe landscape, we've seen kind of two things happen. One, a lot of funding is happening through safes rather than priced equity at the pre-seed and even seed round stage now. So like safes are just the flavor du jour, the right instrument to take in early capital. And then two, as you said, the valuation cap, explicitly in the safe, the reason to use it, or one of the stated reasons to use it, is that you're not actually deciding on the valuation. You're waiting for the future price round investor to do so. But valuation caps sort of function as this valuation idea for these early rounds. And it's a proxy. Yeah. It's weird because it's not a specific valuation. It's always that round number. It's like 8 or 9 or 10. So it's a little strange. But
then you got discounts and you got all kinds of other little things.
There's a lot of different ways to flavors to safes. But in general, what we're seeing is, like you said, companies when the pre-seed stage, which, raising 500 to $1 million, it's about a $8 to $10 million valuation cap, pretty reasonable. And the quality of those companies, I think, is what has really changed. When we talk to a lot of investors in the ecosystem, they say, as you mentioned, yes, we're no longer getting pitches with decks and nothing else. We're getting pitches from companies that have real ARR, actual customer lifts, and are actively improving and iterating on the product, even at that early stage.
Yeah. I'd love to dive in. Do you guys keep track of any of the terms that are changing kind of in these pre-seed and seed rounds? Because, back in 21, you might underwrite a safe with a no discount, no side letters, very plain vanilla YC safe.
Yep.
And now you're starting to run into, I'm seeing, 1 and 2x lick prefs, all kinds of weird warrant terms. Like, are you guys tracking kind of these garlands?
You're running into lick prefs on the safe docs. Oof.
Not necessarily, but I'm just throwing out terms. Yeah.
Oh yeah, for sure. I was like, damn, that's a
weird term. Yeah, that'd be a weird term.
Yeah, totally. We can dig into all sorts of interesting stuff on the deal terms. So maybe starting on the safe side, standard terms on the safe, valuation cap and discount across Carta in, tens of thousands of safes that were signed in 2023. About 90% of them have a valuation cap. And then about 33% of them have a discount, 30 to 40% have a discount. So the vast majority come with a val cap. A lot have a discount as well.
I've actually seen a kind of a move away from discounts. Is that kind of fleshed out in the data as well, corroborated by the data?
It is.
It feels like 3 or 4 years ago, even during the kind of the bubble, a 20% discount was very standard. And now I get a lot of pushback on discounts for some reason.
So discounts, when they are showing up in the data, 20% is still the standard rate.
Yeah.
And basic, like that's 70% of the safes that have a discount have a 20% discount, which means no one's negotiating it. It's just, hey, let's just use 20.
Here's
But
what
to
it
your
is.
point, I find it kind of odd that discounts are going away. It would seem like in a more investor, quote unquote, investor friendly environment, that would be a portion of the safe negotiation that comes back.
Right.
I've also found it weird, like, the safe, people have a lot of different opinions about the safe. The other point that I wanted to make on the terms is that the safes that we're seeing on the platform are more and more of them are coming with a side letter that entails some sort of kind of quasi priced round rights for the biggest investor in that safe round. Things like pro rata, MFN, information rights on the cap table. Those are more common in side letter safe rounds now. And it's sort of like, basically people are just saying, how close can we get to a price round in terms of the rights without doing the price round legal stuff?
Yeah, and I've been on the wrong end of not having MFN in a conversion. I'm like, I should ask for MFN. I didn't know he was giving MFN.
Yeah. Right. Yeah, exactly. You're like, wait, hold on. I could have had MFN.
I converted at a 10, but these other 5 investors got 6.5 or whatever.
Rough. Yeah.
Because they had the MFN. I was like, I should have asked for that.
Yeah.
Come on. Right.
It's the interesting other parts on the safes is that, well, 2 points. One, as I said, people are doing safes, bigger safe rounds earlier on, and also multiple safe rounds.
Yeah.
So it used to be that you would do a safe and then you'd get to price. And now it's like safe for an angel round and then raise the val cap and safe for a pre-seed and then maybe even 3 different valuation cap safes. That gets really tricky on the conversion. I don't know if founders always track how much of the company they're actually giving up there. That can get really tricky.
I'm definitely seeing that too in my portcos is, 3 or 4 rounds of safes.
Yes.
For 3 or 4 years before they get to an A. And maybe that's why the valuation cap discount has become less important, because it used to be, hey, if we convert and we don't hit the cap, like we convert at a lower cap, then you get the discount. But like now it's so far away that by the time you do a priced round, it's going to be probably 30 or 40 million if you even get to that stage of that Series A price.
So that's the key. Like, will you get to that stage? I think that sometimes founders don't realize it's not necessarily like they kind of get, and there's great calculators on Carta to show them, hey, here's how much of the company you're actually selling in each of these safe rounds, especially if they're post money, it's a lot easier to understand.
Yeah.
But what that does is if you're guaranteeing set percentage slices of pie to those early safe investors, it means whoever's investing in your first price round has to raise the valuation so that they can get the allocation that they need in your business.
Yeah.
And that can be, so it's like you might have a perfectly reasonable business, but you've raised 3 safe rounds and your company is worth 15 million. But in order to make the fund economics work for the first price investor, the val really needs to be 20 million or 25.
Wow. I think you're unpacking something really super interesting, which is maybe it's safes that actually have extended out the priced round A or seed.
Exactly. I think that is 100% happening. And it means that the price round seed and A can only fall so far. There's a floor underneath it because of all the safe activity. And a lot of that comes from the ownership requirements by the funds that are investing at seed and A.
Right. Because, I was looking at some of your research and it's so well done. And everyone go out to Twitter and check it out, or X, whatever you want to call it.
Or LinkedIn, if you want a slightly more, more staid, like calm experience. Yeah.
And it looks like, the priced seed and A rounds, these investors are typically looking for 20% of the round, because they want to, they know if this is a successful breakout company, that 20% is going to get whittled away to, 10 or even 5% by the time they go IPO or get acquired. So
exactly. And that's the dynamic that founders, I think, need to understand. It's not that safes are good or bad. It's just that they don't change the dynamics around a valuation conversation. They just put it off. So you're going to have that conversation about valuation at some point. And so maybe my guess is that maybe price rounds or perhaps convertible notes make a slight little comeback in 24 as people kind of get familiar with, this actually has a little bit of downsides, but safes are the default instrument, and that's not going to change for a while.
Yeah. Now, I'm a student of history, and I was actually a history major before I switched to finance.
Myself as well.
Oh, nice.
Poli-sci and history. So.
Nice. I got up to the senior year of college in history, where I'm reading correspondence between famous figures and some not so famous figures.
Right.
And I'm like, this is pretty boring. So I switched to finance.
Letters from old people that I don't get.
Letters between old people in the 1700s. Okay, maybe I chose wrong. But
Yeah.
You know, if you kind of take a look at 2023, what years in history does it feel like?
Mm.
You know,
So
is
this
it
is a
is it like a
question.
2010 or is it like a 2002 or 3, 4? Like,
Yeah, this is a question I get a lot, and
yeah,
unfortunately, just relying on Carta data doesn't give us a lot of historical
right,
context because the company was founded in 2013. So not as much there. If I'm looking back just broadly, I don't think that this is akin to the dot-com bubble. One, because just venture capital as an asset class is so much more well ensconced in
right,
the like whole ecosystem and economy than it was in 2000. So I think that's a big difference. I
yeah,
think it's kind of more like the great financial crisis. The only difference is like I don't think that when venture has been a big deal, there's never been an interest rate change like this. This is the
mm,
biggest interest rate change that we've ever gone through with venture being a mature asset class. So I do think that that is messing with people's heads, and it's kind of putting off, like, everyone wants to know, when are we going to get back to normal? I don't, I'm not sure that like back to normal is going to happen at one moment. Like, it's just going to be a slow mini chunking. And as I said, some companies aren't going to be able to make the switch and they're going to have to shut down, or there's just going to be a lot of messiness.
yeah. And we seem to kind of run in 7 to 12-year cycles anyway, right? So if you
For
kind of
sure.
look at early 90s, early 2000s,
Yes.
early 2000s to 2009, 10, you know,
Yep.
these are, 7 to 12 year, call it 8 to 10 year kind of cycles. So,
Yeah. Yep.
so if you look at the last peak, 2021, you're probably looking at late 2020s for another peak.
I
It
agree.
could be earlier, could be later, but it's going to take years to kind of climb out of the hole.
And the question is, for all you mid-round VCs listening in,
Mm,
if all of the noise about, okay, startups can need $1 to $3 million and then fund themselves out of customer revenue and still achieve like venture scale outcomes, if that's true, like, what happens to the middle part of
ooh,
venture is a really interesting
I love
question.
this question.
I have a little bit of skepticism as to whether or
Yeah,
not you actually can achieve venture scale outcomes without venture capital
yeah,
for the majority of cases. But even if it's only a little bit true, it really changes the dynamics for
yeah.
mid round venture.
You're talking Series B and C kind of investors.
VC, like,
Yeah,
if you don't need a $25 million capital injection because you're growing super fast, like if you're mid journey,
yeah,
if there are more mid journeys than not, how do we,
right. Opus.
where does that capital go?
Yeah, I just saw Opus, which does our podcast clips. So if you watch our podcast clips, it's Opus AI. I recommend that company. I think I saw. I won't say exactly what revenue. I'm sure it's private, but I was like, wow, pretty significant revenue per
Yeah.
employee. And I think the point you're making is something I'd love to drill into and kind of opine on, which is, yeah, what is that kind of 5 to 10 year future of mid stage VC? Like, I know as an early stage pre-seed and seed investor, it's a feeding frenzy out there.
Yep.
There's tons of startups that need tons of capital. They have more traction than ever.
Yep.
They're getting default alive quicker than ever. They're scaling infinitely with AI and software tools. And I'm seeing companies with 2 or 3 founders and $1 million of ARR and
Yep.
no employees. And Sam Altman, there's been headlines about he has this internal kind of betting circle of like the first Fortune 500 company will be with like a single employee, like the single
Was the
founder.
bet for him that there would be $1 billion valued company or $1 billion
Yeah,
ARR company? Because those are like two vastly
different things,
Yeah.
right? But either way, I mean, just to have that discussion is
Right.
absolutely incredible, right?
Totally. Yeah.
To be in a world where AI is accelerating so fast, and maybe it kind of inverts for venture capital, I think is what the underlying point you're making there,
Yeah.
which is maybe you don't need these big Series B, C, and D rounds anymore, because companies can now start infinitely scaling with AI, and
Yeah.
it kind of hollows out venture capital in a way, or kind of pushes it down into the pre-seed and seed,
It pushes it down, but it also means it effectively, unless you're going to do the most spray and pray strategy of all time, it effectively limits fund size as well. If your check is 500K to $1 million, you can't be $1 billion fund and expect to have enough viable companies. Like, it just doesn't.
Bingo.
I don't think the math works.
Bingo. So it's almost like a return to the venture roots of this
Yes.
cottage industry that we were.
Yep.
Maybe the peak venture, maybe 2021 will go down as peak venture of all time, perhaps. And we'll look back,
possible.
And right, because that was kind of peak everything, and maybe venture. I don't know. Like, I'm sort of bullish that there's more startups in the future, not fewer. I do feel there's more entrepreneurship, and I feel like AI is an accelerant to that.
Yes.
That generates more software and enables teams to do more than ever, right?
Yeah,
And I see that in my portfolio companies in the pitch decks that I see
definitely.
coming. But it's a really interesting thought experiment to think like, what if you don't need to hire thousands of people
And I mean,
to
to
get to $1
that
billion in
point,
revenue. Yeah.
like companies on Carta took that message to heart this year more than ever before. So if you look at, we have the other part of the Carta data set, which I love, is that we have data on sort of the employment market in startups, because we know when someone's granted equity, and then
Yeah.
when they leave, that equity grant is obviously terminated. So we know when they leave, and we can track changes and all that stuff. So
Yeah.
if you do that on an aggregate basis, companies, the 40 or so thousand companies on Carta hired about 500,000 people in 2022, and they hired 260,000 people in 2023.
So
So
that's
like
a 50% decline
that
just overall in
giant
hiring.
drop, right?
Yeah.
And then if you add in, okay, that's the hires, but then if you compare it to the leaves, both layoffs and voluntary leaves, that was actually 275,000 in 23. So more people left Carta startups than were hired at Carta startups last year. The
Wow.
first time we've ever seen the whole industry, quote unquote, shrink. And if that's, if 2024 isn't a return to boom hiring, then you're really looking at like cottage industry is the right way to put it. Like startups as an industry will be smaller in terms of investment and headcount. And that's a totally new paradigm.
Right. Yeah, and it bodes well. And this is what I tell my LPs is like, it's a really awesome time to be a very early stage investor.
Yes.
Again, it's never been a bigger feeding frenzy, but it's a terrible time to be that mid-stage investor, like you said.
It's really hard. Yeah.
Or even late stage, right? Because now you're, like, especially if you deployed a lot of your capital in 22, 23, markets are closed and you can't unlock that quick 3 to 5x that you were hoping for in 3 to 5 years.
Yeah. The lack of IPOs is like a big deal.
Yeah, versus a pre-seed investor like me, I'm like, cool, here's a little bit of that 500K round. You're raising 500K and you have 500K of ARR. That's awesome.
Yeah, right.
Yeah.
That sounds great.
That sounds great. Here's my money.
Yeah, right. Yep.
And then they keep growing. And then, AI just keeps accelerating everything and making marketing and sales. And you've seen the headlines with OpenAI and Klaviyo.
Yep.
Right? Where they implemented OpenAI into their customer service workflows and saved them $40 million a year. I mean, this is the kind of stuff that's happening right in front of our eyes.
Yeah. It's a fascinating time. But I do think that perhaps in addition to peak investment in 21, like peak employment in startups might have been 2022. There's a little bit of lag because the highest month of hiring was, January 22 for us. But will that be the case? How quickly can that 5-person team get to 10 million ARR, that kind of stuff? Like you're hearing that a lot. Now, maybe we're just creatures of habit. And as soon as there's a boom to pick up on, like hiring will inflate to the boom times, but maybe not. Maybe there's been a real structural change.
Yeah, I bet you could probably pull up data, or you probably already have around kind of the employee count per million value cap or something like that. So that's another test of a tech company's ability to create value is kind of revenue per employee. It's something like Amy Hood at Microsoft, where I worked at for years, would watch and tell the street very carefully. And half of the jobs at Microsoft were contractors to try to keep that number as high as possible. So I wonder, have you guys looked at sort of the value cap per employee, like how that's being impacted with AI and stuff like that?
We looked at this a while back, so I don't have great numbers for you in the AI boom, but already in 22, people were cutting costs and headcount pretty aggressively. So it was trending downward. The point that 22 was a weird year for people who had just joined startups. I think one of the other findings from the recent report was that something like I'm just pulling it up right now, but like so if you take each cohorted year and say, okay, you are a 2021 hire, a 2022 hire, et cetera, 23% of the people that were hired in 2022 did not make it to their first year anniversary at that company.
Wow.
That's the highest. Historical averages are more like 15. So from 15 to 23, it's the highest year that we've seen, and 2023 might actually be higher. Obviously, we don't know to the full into 24 exactly what the full year is, but so many people, like there were so many junior and less tenured employees that left their companies, a lot of it by layoff last year, and I think that's probably not going to get replaced. Like we don't have, we're not seeing backfills come up to the level of departures.
Yeah. And I think another trend anecdotally that I'm seeing, and I don't know if you guys have data on it, but I definitely feel it, is the kind of the rise of fractional work. I talked to lots of people, Team Ignite, of course, is this big network of LPs, thousands of people that help ignite startups. So I talked to a lot of these mentors and advisors and LPs on Team Ignite, and anecdotally, they'll just tell me like, I don't want to go back and like be an exec at some big tech company. I'm good.
Yeah,
I'll just take some fractional roles and live in Idaho and fly fish and stuff like that.
Right. I'll do some advising, I'll do some consulting.
Yeah. And I feel like everybody's kind of reoriented, and so like there's almost like this like I don't know, this dumbbell shape to the way I perceive it, which is like you have all these early stage startups doing all this really cool stuff and lots of fundings. And I'd love to dive into that data.
Sure.
And then this hollowing out of the middle that we were just talking about. And then on the other side, you still have these huge, like massive tech companies. And yet we have very low unemployment. Our inflation's still relatively high.
Right.
And people just have reoriented their lives. And it almost feels like we're entering kind of like this weird proxy for post-capitalist society or something where like everybody's just like, I'm just good, I'm just gonna go live and on a farm and work 20 hours a week on Upwork or Fiverr and just call it good. And
and so the AI is so good that Upwork and Fiverr goes away, so that's like, I don't know, there's questions there. I'm with you.
I hire people on Upwork too, and so they're doing screen captures and screen records of all the tasks, so they have lots of data of people working on stuff.
100%.
Yeah.
It's a wild time. It really does feel as though the shift in 22 and then obviously the release of ChatGPT in November is like, it marks an end of an era in tech startups. And like, this is the new era. And it's really hard to say exactly what that new era is going to be defined by, but it does feel qualitatively different.
Yeah. That's really interesting. But back to kind of pre-seed seed fundings, like what are you guys seeing in the data on that?
Yeah. So pre-seed was just slightly down year over year. Seed was down, but definitely doing better than the rest of the venture ecosystem. So I think it's a truism to say the further away you are from IPO, the better the fundraising environment is at the moment. We're also seeing that, like, on just to put some raw numbers to the valuations and things, seed rounds on Carta, those are priced seed rounds. The median valuation for a US seed round in Q4 of last year was 13.3 million. So pretty robust. If you add that to the 3 million or so that a company might raise, it's about 16 million on a post-money basis for a primary seed stage valuation. Seems pretty reasonable. It's actually quite close to where that was in 21. Just like hasn't fallen. Now, obviously, inflation, the cost of money, all that kind of stuff is different, but on just like a raw number basis, it's pretty close to where it was at the peak. Series A, more decline in 23, but a faster pickup. So Series A is back up to about 44 million on a pre-money. So it's
almost like like when you whip a rope.
Yes.
And it kind of takes time to kind of travel down.
Yes.
Like almost like venture funding, the stages are kind of like that rope, right? It's just kind of going, and then I think
that's a perfect analogy. If then you also say that like someone sort of stops the rope at some point because it like the early stages can't go that low. It's like, no, that's enough. That's enough pain for that. Whereas the later stages, like the valuations and fundraising.
Yeah, the beta is very high at the late stage.
Yes.
Right. The market goes down 20-30%. Those late stage valuations are probably 2x beta. It's going down 2x more than the market.
I would agree with that. And it takes a little bit of lag. But so in general, I think the early stage in startups is actually pretty healthy right now. Valuations are decent. Round sizes are decent. You've got the messiness with safes, which makes this a kind of a difficult thing to track. But the other point is that when we track dilution, so like how much ownership are founders giving up at these stages, it's relatively flat. The old rule of thumb of 20% for a seed and 20% for an A seems to be holding pretty steady. So it's not as though investors are demanding much, or receiving, I should say, they may be demanding it, much higher ownership percentage than they used to. Some of that may be just in the rights in terms of the deals have changed a little bit, but by and large, I think it's still a decently healthy market there.
Yeah. And what do you see in the pre-seed? Is it typically like a 10%?
Yeah, so it depends on the size of the pre-seed. If you're doing an angel round, which we would define as anything less than, call it we call it 300 to 400,000, you're probably only selling. I'm pulling this data up right now, but you're probably only selling between like 5 and 6% of your business.
Yeah, these are typically angels and friends and family and folks like that. So
exactly,
giving you a little bit better terms and stuff like that.
For sure, there's a lot less side letters in those rounds because they're just not being asked for. And then you get some institutionals actually playing in the 500 to a million round size, and that's 8 to 10%. And then if you get to what we would call a seed on safes, if you're raising $2.5–3 million on a safe round, that's a seed round. It's just being done on a different instrument. And there, it's actually good to see the math makes a lot of sense. Like safe rounds that are going off for $3 million, the founder is selling 19 or 20%, just as they would if it was a primary round that was being done on priced. They're just kind of just saving on the legal costs.
Right.
And maybe setting themselves up for a trickier conversation down the road, but we can leave that to one side.
Yeah. My favorite conversation is a founder that was raising on too high of a cap for their given traction. And I'm like, hey, very interesting. Everything looks good. Stay in touch when you get more traction.
Yep.
And 9 to 12 months later, they come back and they're like, hey, we're reopening the safe at the same valuation. Guess what? It's still the 15 cap, but now we have triple the ARR. I'm like, see, I told you.
You're like, you nailed it.
Nailed it. And I come back in.
That's the weird part about the safe stuff is that you never have to end it, right? It just
it's just kind of rolling out there. Yeah.
And it goes along, which is good in that you can always bring in capital, but bad in that I feel like people, if you're fundraising on a safe, it kind of feels like you're fundraising more often. Like you're always sort of...
It's kind of this perpetual party round, right?
Totally. And it
just kind of becomes this like never ending, like rolling. I'm always raising for 3 or 4 years until I get to my Series A.
Yeah. And then, you think you're saving on the legal cost, which you are versus a priced, but then you get to the priced and your lawyers are like, oof, we got a lot more work to do on this.
A lot of safes here. There's 58 safes on the cap table here. They all have different terms and conversion caps and discounts and side letters, and oh my gosh, this is going to be a nightmare.
So I get it, founders. It's good to raise on safes because it's easier, faster, rolling, all that stuff. But like having a good lawyer still matters. Like you're going to need one.
Yeah. And would you recommend that to founders out there? Like if they have the option to go priced in the seed, what are some pros and cons there that you see?
The pro is that you will clean the cap table up. You'll have all those conversions modeled out, and then you'll also go through due diligence in a really serious way, which maybe actually will be good for your business. Yeah. The cons are time and legal cost. So debating between those two. The other thing is that some investors have strong preferences on whether or not they do big safe rounds or they would rather you go to priced. I think it's sort of a personal choice, but I don't think that going to price is a bad option. And what I would say is that if you're getting to the 3rd or 4th separate valuation cap, you should probably think about price next because it's just getting really complex. And you don't want to be caught unawares. The other thing to note is that people are using safes and convertible notes in between priced rounds now as bridges and extensions.
Yeah, I've seen that. I'm starting to see that. I never saw that before.
We hadn't seen very much of it before either, but
you're writing a safe. You already have a priced round, and now you're raising another $1 million, but you already have a cap table with price shares, preferred shares, but you're doing a cap against the future round?
100%. And
it's weird. Yeah.
That cap by definition is not going to be negotiated in the same way as a priced round cap would be. So it's like gonna be wrong. It's gonna be low or high. You don't know which, but to me, it just feels like this is the easiest way for an insider on the cap table to bridge or extend this company. But to me, that is the place.
I stay away from those. Yeah, I stay away from those.
Like weird. At least use convertible notes, at least. But like,
why use a convertible note versus a safe?
Well, at least that convertible note comes with a maturity date with the interest rate, so it's like a forcing function to a future conversation. Yeah. But to me, it seems odd to use the safe in between priced. I think it's going to happen more and more as people are talking seed extension, seed plus, mini Series A. Like, the names are proliferating.
It's all seed all the way down. Like it's all turtles all the way down.
Exactly. Lots of turtles.
Perpetual turtles.
The fundraising turtles, as we call them. Yep.
And since Carta has, over 10 years of data on this stuff, how has the kind of the pre-Series A progressed in the last 10 years or evolved? And given that progression and kind of this post-peak all-time environment, where do we see the trends going in the coming years for the pre-Series A?
The pre-Series A is attracting more capital than it used to. There's just a lot more funding that happens. It's one of the reasons why, if you look at the funding timelines, they've been extended out, not necessarily because it's taking that much longer in between a priced A and a priced B, but just that getting to the priced A in the first place is taking longer because you're bringing in funding on all these convertible instruments to begin with. And partly, I think that is responsible in some way, shape, or form for the extended period that companies are just staying private. Like a company on Carta that IPOs, I think the median over the last year was something like 10 years. It used to be like 8 or 9.
And it's going to go from the priced round or from the founding of the company?
From the founding of the company, but that's still, and it'll get to 12, I would expect, before the end of 2020. Like it's a long time that people are staying private.
A long time.
And that, I think it's underrated how much of a change that is to the way, especially liquidity works in the private markets. Like if you're an employee and you're not going to have access to any of the value of this stock for a dozen years, it's a different calculus than 6 years. It's a very different thing. So that, I think, is the biggest change, is that all the pre-Series A funding extending out timelines and making liquidity a little bit more of a nebulous prospect for a lot of people that are involved.
All right. And there has been, the rise of the secondary market, right?
Yep.
Equity B, there's a bunch of others out there that, they basically help people exercise and sell their shares. So there's been a little liquidity for employees, but what kind of changes would you like to see kind of in that private versus public market? Because it feels like it's here to stay. I feel like the private markets are open for business. They've extended IPO timelines. I mean, Amazon went public after 3 or 4 years.
Right. Yep.
Netscape was like 2 years. I think Google was 6. Facebook was 6 or something.
Yeah.
It's just taking a lot longer. What do we need to do there to, I don't know, bolster it or make it more transparent
It's definitely a valuable question to dig into, because if a lot more of the growth of the company is going to come before IPO, you want more people to have access to that growth, even if who would have been public market investors. And I guess there's a reasonable debate to say, like, look at NVIDIA. There's a ton of growth left after you IPO if you're the right company.
Yeah.
But be that as it may, some of that comes down to things like the accredited investor threshold, which, back and forth on policymakers, whether or not that should be that cap of however much you need to make in order to qualify as an accredited investor should be risen, or should you use things like financial literacy tests or like CFAs and things to say, look, you may not have the capital, but you're a sophisticated quote unquote investor.
Yeah, don't we already have that with like the Series 65 or 66?
We do, basically, we do, but the discussion is like, do we raise that tier? And to me, it always felt weird that I can YOLO a bunch of money into the next crypto thing as quickly as I want to, but I can't invest in my buddy's startup. That seems odd.
That is weird. Yeah.
And so like that seems weird. And then on the liquidity side, there's a lot of different people that are thinking about private market liquidity. I don't think it's ever going to be, hey, log on to a Charles Schwab and trade in private stocks. Like that's just not going to happen based on the way the regulations work. But I think there will be more innovation in liquidity.
I mean, the government could step in and just say, hey, enough is enough. These companies are getting too big and destroying value.
Yeah.
Especially for, big, NGOs and foundations, endowments. And we've seen a lot of capital destruction.
Yep.
Especially from the peak. And, maybe that wouldn't happen as much in the public markets under the scrutiny. And so maybe the government could step in and say, hey, after $1 billion or 5 billion, 10 billion, whatever the number is of value, you have to go public.
I bet they're thinking about it.
Yeah.
I don't know if I have an opinion as to whether or not that's a good thing, but I don't think. I don't
know if I'm for or against that, but I can see the government.
That wasn't a topic of discussion.
Yeah. It's like, is there a trigger where it's like, hey, there's too much value here,
totally.
And it needs the kind of the public scrutiny to make sure you're not destroying value and burning out capital and screwing over employees because you gave them overpriced options that will never be in the money and all that stuff.
Right. The equity side, Carta's equity database, I think is pretty unparalleled, at least in the US. And one of the sad parts about the downturn gets a little less press than the shutdowns and things, but employees are exercising their equity at like record low rates. And a lot of that is just smart financial decision making. If you or I worked at a startup and we got laid off because that startup had a down round, how likely is it that we're going to exercise that equity? Probably not.
Exactly.
But it is sort of wrapped up in the promise of joining a startup is the upside in that equity. So like more education, more options for those people to exercise the equity, longer periods, like the 90-day. I know why it exists because the ISO has the 90-day tax treatment, but it's, as a personal note, not speaking as a Carta here, I think it's super silly that most employees only have 90 days after they leave a company to make this decision. You know, at Carta, it's actually indexed to how long you've been at the company. I think that's more reasonable. But even if that's not your approach, like there's things that we can change about the way equity works in startups that I think would have an impact on the upside liquidity value.
And I remember being a startup employee many, many times, getting all kinds of equity packages and just being completely in the dark on how should I value this? How much is this worth? What percentage of the company do I own? How much is 50,000 shares? Like,
yes.
Is that strike price good? What does that mean? And then, oh, okay, you left, and now you have 90 days to cough up, somewhere, 5, 6, 7 figures of cash.
Totally.
To exercise, and that might be at a sky high valuation. That was 100x revenue because it was some AI company. Anthropic just raised at 180x, right?
Yep.
And if you're an Anthropic employee who just left, you're like, do I exercise?
What do I do?
Yeah.
What is
that's not fair for them. They're not sophisticated financial wizards to figure this stuff out.
I think that startup employees sometimes feel, I'll just use I terms here. I felt nervous asking those questions before I got to Carta. I'd worked at startups and I was like, I guess I should probably already know this. Like, am I just being dumb and not understanding?
I remember feeling the exact same way.
That is like 100% untrue. Everybody at Carta asks these questions and we know more about it than anyone. So like people should ask the questions. They should, if you're negotiating an offer and you're joining a startup, if the startup that you're joining is only willing to give you the number of shares, that's not enough. That doesn't make any sense, right? You don't know the denominator. You don't know the ownership percentage. You don't know at what. One of my
what about the LickPref stack?
The LickPref, my favorite question to ask if I was a startup employee listening to this and I was thinking about joining a new startup, the question that I would ask would be, what does the price per share need to be in order for common stock to make a profit? And what that does is it does two things. One, it forces the HR and recruiting people to know that number, which they may not. And two,
what's the in the money price here?
Right, because you need to take into account those that preferred has a different LickPref than common. So you only will make money if the exit is good enough that it flows past the preferred threshold.
And that could be 2 or 3x your share price.
It might be 4x these days, with the terms that people are signing. So I love that question as just a way to say, suss out, hey, is this company for real? Like, do they know how to talk to employees about the value of their equity? Because I sure as hell know when they're pitching me, they're talking about the upside of this equity. So they should be able to give me like, what are the real data on the upside here? And what does it mean for me to share in the value of this once we get acquired or IPO?
Yeah. And let's not forget too, that you're locked up as a common shareholder, insider for 6 months after IPO.
Yes.
And in some cases after acquisitions as well. Like you're beholden to the public markets. And I've had many friends from many different startups in Silicon Valley that, thought they were worth 10, 20, $30 million on paper and then weren't. And it's pretty sad.
It's a tough pill to swallow when you are paper millionaire and then not. That's hard.
Yeah. So why don't we kind of wrap up with a few rapid fires?
Let's do it.
Yeah. So what advice would you give early stage startups navigating the current funding environment?
Start fundraising earlier than you think you need to.
100%.
Secondly, your first contact with an investor should not be asking them for money. You should establish a relationship with the people that you think are going to be important to you. And I actually think one of the cool things we're seeing startups do is the ones who are taking it really seriously, they're taking a look at who they're going to need to invest in them at the seed or the A. And they may put them on their investor updates or get in touch with them early on and say, look, I know I'm not your target audience yet. I'm too early, but I'm working towards you. And here's the progress that I'm making so that in 2 years, you come to that person and they say, oh, we've been following your progress for 2 years. Yeah. Of course, we'd love a conversation.
Well, there's also a cognitive bias at play, which is like a familiarity bias.
Yes.
Right. And I fall prey to this as an investor. I'm like, oh, I've been getting your updates for 2 years and now you're ready to raise your seed round. Like, yeah, I'll take the call.
Right. Exactly. People wonder how to get warm intros. It's like, do it 2 years earlier than you need to. And it's a lot easier that way. Yeah.
Right. And there's tools out there to find all the investors that are a
Yep.
fit for you on like NFX or
Yep.
PitchBook, Crunchbase, Carta, whatever. Get out there and find your people. Yeah. What kind of regulatory changes are you tracking that might influence startup funding?
I think we have actually a fantastic policy team at Carta that tracks all of this. We have a newsletter if people are interested in it. But well, the one that keeps coming up when we talk to fund managers is actually the private fund advisor rule. Changes the reporting requirements for some early stage funds, some venture funds, some private equity funds. But there's always sort of a slight worry or skepticism that the SEC is going to come in and just kind of ruin the party on early stage startups. I don't know if that's going to happen down to the level of the founder, but like fund managers should definitely be aware there may be changes coming with the SEC. And obviously we have an election, so who knows what's going to happen in the next year.
When should a startup take corporate venture capital, or do you guys track data around that and how effective that is for startups?
No, we haven't broken it out. I guess the common advice that I hear for corporate venture capital is that it is an effective way to pre-wire a potential acquisition. But the downside is there are people who don't love CVCs on the cap. And then there are also downsides in that the CVC might not care as much, or it's not as germane to the full corporate's business as to whether or not these individual investments work. It's not the same as taking from an emerging manager who absolutely, like, the DPI that they get off these investments is how they're going to make their business work as if they stay in corporate or stay in venture capital overall. So a little bit of a different incentive structure for VCs.
Yeah. I remember I was at Microsoft when they shifted M12 up. They used to be a financial investor.
Yep.
And they switched back to just being a strategic. We're going to try to invest in solution areas that are aligned to Microsoft's strategic goals.
Exactly.
Kind of a Warren Buffett kind of question. Where do you see, there's obviously AI is overhyped. Are there any other things that are kind of overbid right now in the data versus maybe some value plays out there that investors should know about?
Don't generally want to prognosticate too much. AI is the category that grew the most last year. It will, I think, again, remain that top spot this year. The other, I think, cool things, I don't know if they're overbid, but we have seen slight rotations away from bits and towards atoms. So things like robotics, hardware, biotech, real world things. There's all the stories about El Segundo. Those are real. There's been like what's
the story about El Segundo? I don't know. Oh, El Segundo, the Tribe Called Quest song. I left my wallet there, but
Gundo, I guess, as it's being called on Twitter. Just a collection of hardware, cool startups that are in the El Segundo region next to LA or in LA.
Nice. All right.
Cool folks. I think that's a good thing. People taking bests where the risk is not necessarily just executional, but like, can this even be done technically?
Yeah.
I think those are.
I'm really excited by robotics. You have so many companies like right on the cusp of releasing humanoid scale and level cognitively capable robotics. I think that's one of the trends coming in the next 5 to 10 years. It's going to really reshape our whole economy.
Totally. I think it's fascinating. The one other point that I'll make is, and this is a bit of a downer note, but there are certain categories for which venture capital is just not as much of an option anymore. And I'm thinking specifically of DTC retail. All of the Allbirds, Warby Parker, etc. Like, it is really difficult these days to get venture funding for a new beverage or a new, a new line of apparel. It's not to say those businesses can't be fantastic businesses. They're just not really VC backable as much.
Yeah. Well, it's hard to say that. Okay, we're gonna have this huge inventory cost.
Yes.
And it has what margin again? Okay, great. And like, what's the return ratio? And
how are
you
those
start squinting at it?
Public market, like, can you tell me about where they are?
Trading at 3x forward revenue, like,
exactly.
It gets hard to kind of squint. And I've heard and I believe B2B SaaS and biotech are kind of the two best places to be a VC. And I don't know anything about biotech, so
so that means B2B SaaS. Yeah, there you go.
It's just B2B SaaS.
Have you seen that meme that goes, too late to explore the earth, too young to explore the stars, but just in time to sell B2B SaaS?
That's
that's really good. That's us. Yeah, we love it. Yeah.
Well, Peter, this is an amazing conversation. We'll have to have you back on the pod when the next big research report drops. Where can people get in touch, and how should they learn more?
Absolutely. Yeah, this was fun, Brian. They can always find me on LinkedIn if you type in Peter Walker Carta. You'll find me there. And if you haven't, please join the Data Minute newsletter. It's about 22,000 people now who get one chart a week out of our database about something interesting in startups. So
that's
if you found this conversation fun, please sign up to that.
How do you sign up? How do you find the newsletter?
You can just type in Carta Data Minute into your search bar and it should pop up.
Oh, nice. Okay. Well, thanks so much, Peter. This was amazing.
Absolutely. My pleasure.